Hi, and welcome to today's ISDA webinar on US dollar LIBOR final steps. We're joined today by the key global CCPs who will soon be transitioning their portfolio of US dollar LIBOR products to SOFR products, as well as Bloomberg, who publishes the fallbacks that may apply to your non-cleared derivatives after US dollar LIBOR ceases to be representative. I'm Ann Battle from ISDA, and I'm joined by my colleague, John Martin from ISDA. From CME, we have Steve Dayon and Dave Reef. From Eurex, we have Adi Dadam and Kalina Nachiva Akar. From LCH, we have Phil Whitehurst. And finally, we have Jonathan Seymour from Bloomberg. Before jumping into the fallbacks in the CCP transition plans, I just wanted to give a brief background on the relevant floating rate options for both US dollar LIBOR and SOFR in the ISDA definitions in order to set the stage for some of the terms and products that we're going to cover over the next hour. So here we have two broad categories, and these categories generally apply in both the historical 2006 ISDA definitions and the current 2021 ISDA interest rate derivatives definitions. In the box to the far left of the screen, you have US dollar LIBOR floating rate options, or FROs. And the important thing to understand there is that if you have a non-clear derivatives confirmation that references one of those US dollar LIBOR floating rate options, then within that floating rate option, you have the fallbacks to the SOFR-based rates that are published as fallbacks by Bloomberg and that Jonathan will go over shortly. So if that contract is not voluntarily transition to a different rate between now and the middle of the year, then when those fallbacks kick in, the floating rate option for that contract in your confirm will not change, but the rate that will apply going forward will be the SOFR-based fallback. And that is the case for any transactions referencing those definitions that were entered on or after January 25th, 2021, the date that those amendments took effect, or any contracts that were remediated because both counterparties adhered to the 2020 IBOR fallbacks protocol or otherwise bilaterally agreed that those fallbacks will apply. And then on the other hand, we have a whole tree of SOFR-based floating rate options, or FROs. And those are the rates that are used if you enter into a SOFR OIS or a new SOFR-based contract today. As I think is well known, the significant majority of interest rate derivatives are based on SOFR, and that's predominantly using, if you look at the red box in that second row, the self-compounding SOFR FRO. And that's the FRO you're using if you're using SOFR compounded in arrears with standard OIS conventions. And so again, those are new floating rate options. So those confirmations reference SOFR itself. And as the CCPs describe, when they transition, they're actually going to be transitioning their US dollar LIBOR FRO products to SOFR FRO products instead of falling back to the contractual provisions. But as they will also describe, these conversion practices utilize the mechanics of those fallbacks in order to accomplish the transitions. But that's really the key difference I wanted to point out on this slide. If you have a non-clear derivative that will reference fallbacks, your floating rate option does not change. If you're going through the CCP process, pay attention. Each of the CCPs will describe the instruments involved, but ultimately you will have a SOFR-based floating rate option. I'll now turn it over to Jonathan Seymour from Bloomberg to talk more about the non-cleared derivatives fallbacks.
Thanks, Anne. Hello, everybody. So I'll talk generically here, but specifically on the point is US dollar LIBOR. And for that, the fallback rate is SOFR. Now, for the fallback rates that are used in any of the calculations, we are going from a term structure in LIBOR, for example, with a credit sensitivity that's built into that rate, to an alternative rate that's the overnight risk-free rate. So in the case of SOFR, we have to take a compounding approach to the SOFR rate to bring it in line from a term approach to the same tenor that we need for the LIBOR rate to replace. And we need to reflect the historical credit differential between the LIBOR rate from the interbank lending market and the overnight risk-free rate. So we break it down into two parts. The risk-free rates, or in this case SOFR, is compounded in arrears. So we have to wait till the end of the period for which we need the overnight SOFR rates to compound those over the same period as the tenor of the LIBOR rate that we're trying to replace as a fallback. To that, we add the spread adjustment, which is the credit spread adjustment, based on a 5-year median of the difference between the LIBOR rate for the same term, tenor, and the compounded risk-free rate, looking back over history. The methodology is generic across all IBORs and fallbacks that we calculate for. There's 19 rate sets at the moment that we publish these numbers for. In the case here with US dollar LIBOR, and like all the others, we use what we call a 2-day offset lag. We shift the calculation back for the period that we're measuring by 2 business days. And this is to ensure that in the vast majority of cases, the fallback rate is available 2 business days prior to the payment date. So in the new world we're moving to, you're essentially waiting to the end of the period to get your rate to determine your payment, rather than, as LIBOR has, the rate available at the start of the calculation period. Now, spread adjustments are already known and published and fixed. This was as a result of the FCA announcement of the deprecation of LIBOR. It was on the 5th of March, 2021. So those rates are published. The spread adjustments, for example, you see in the table here, 1 month and 3 months typically being used in the marketplace primarily. So it's 26.161 basis points for the 3-month LIBOR tenor. So that is the rate that's fixed and will be added to the compounded SOFR rate on the date that we're looking for a fallback rate for. Best way to look at this is maybe graphically as to how the 2 components are broken down. The fallback rate in itself, you see at the bottom of the slide, is simply the combination of the 2, the spread adjustment and the compounded risk-free rate, the adjusted reference rate. If we look at the middle of the slide, you see the term original IBOR rate record date. This is the date for which we're looking for a fallback rate to apply in lieu of the LIBOR rate that would have been used. Now, the spread adjustment has been done, but just to put it into context, you're looking back historically over the 5-year period, plus the term of the tenor and a 2-day shift, 2-day business day shift, to observe the LIBOR rates over that period. We also take the SOFR rates for that period compounded over the 5 years, looking backwards. That means that at the date that the cessation announcement was made, 5th of March 21, we knew at that point what the spread adjustments would be for all of the fallbacks going forward. Now, looking on the right-hand side of this graphic, you see the terms, the fallback observation date and the payment date. So this is the time when you look for the fallback rate that you require, in a sense, 2 business days prior to your payment date. And because, as I said, we're waiting for the SOFR rate to appear every day over the tenor period that we need to compound, it's that period of time that we need to wait to find the compounded rate to determine the fallback rate as of what we call the observation date. And we'll come back to this point about how that works within the ISDA definitions in a moment. We move on one more slide. Perhaps this more specifically will show the example of how the calculation works for US dollar LIBOR fallback on any given date. So I'm using here a 1 month tenor as the example. So if we start from the date that we're looking for a rate, in this example, we've just used what happens to be a non-business day. It happens to be Thursday, the 16th of the month. Let's imagine that's Thanksgiving in the US. So that's a non-business day, but we still calculate a rate for that day, a fallback rate for that day. The methodology requires us to find the spot starting date for the accrual period. And that is, in the case of LIBOR US dollar, it's 2 business days. So you move from the 16th in blue forward 2 business days. That takes you over the weekend to Monday, the 20th. This is in yellow. This is the spot start date for the accrual period. Now, the methodology for compounding for all fallbacks requires you to take a 2-day shift backwards. And this is to help ensure that the rate is known 2 days prior to your payment date. So we move backwards 2 business days, reference rate business days, and that shifts us back to the 15th. 2 business days, we skip through the 16th, which is a non-business day. Now, this is the accrual start date. And now we are going to measure the SOFR rates from the accrual start date all the way through to the end date. And that, in this example, is a 1 month tenor. So we simply move forward 1 month to the 15th the following month. That happens to land on a non-business day, a Saturday. So applying the modified following convention, we move forward to the following business day, which is the Monday in red. That's the accrual end date. So the SOFR rates for all of those dates, excluding the accrual end date, are used in the compounding. So maybe if I work through that step by step on the next example, the way to think about when a rate is available is to look at what will be the calculation date. So if I need to work out when will I know the fallback rate for today, Thursday, the 13th of April, for, in this example, through the 3 month tenor, I can work through this methodology in this approach. So step 1, the original rate record date. This is the date we want to replace the 3 month LIBOR rate for, hypothetically, with the fallback rate. So step 2, what is the accrual spot date? According to that graphic on the last slide I showed you, we add the spot lag or the value lag, LIBOR value lag, which is plus 2 business days. This takes us through from today, Thursday, 13th, to Monday, the 17th of April. So you may also see this terminology as the reset date within your swap. Step 3, we take off the offset lag, the 2 business days that applies in all these calculations. So we shift backwards 2 business days, which brings us back to the 13th. Okay, this is your accrual start date. So now we're going to take the SOFR rates from the accrual start date all the way through to and excluding the accrual end date. So we add the 3 month tenor, simply 3 generic calendar months, which takes us through from the 13th of April to the 13th of July. This is a good business day. It's a Thursday. So the last SOFR rate that we're going to use in that compounding period will be for the previous day, not the accrual end date. That's the rate that is value for Wednesday, the 12th of July, but it will be published on the 13th on the accrual end date because SOFR is published on T+1. So this is our calculation date, the day which we will calculate and publish the accrual end date, the 13th of July. The formula is published in our methodology document. Essentially, it has the standard compounding formula, which you see bracketed in A. We have to make an adjustment for some other IBORs where the day count differential is different for the risk-free rate that we're moving to as a fallback compared to the IBOR rate. This happens in the Japanese market, for example, in Norway, not in US. We have actual 360 as the day count conventions for both SOFR and US dollar LIBOR. So the factor is 1. And then an annualization factor, which is B. Remember, we have to add the credit spread adjustment. So this has already been fixed and published. It's 0.26161% for the 3 month tenor. So on the 13th of July, we will publish the rate for the 13th of April for the 3 month tenor. So that's a step through of how the calculation works.
John and I are going to talk quickly about how what Jonathan described works within your contracts, because there's a few more important points to consider. So as I mentioned, the fallback rate is within the US dollar FRO, and Jonathan referred to the beginning of the period And for purposes of looking at your contractual language, an important term is original IBOR rate record day. That is the day that you would have observed US dollar LIBOR. So under the standard definitions, that is 2 days for a vanilla interest rate swap. That is 2 days prior to your reset date. So when you have, for example, a reset date of the 15th of the month, which is a Wednesday, and there's no holidays, you if that was your reset date for a contract using US dollar LIBOR, you would observe US dollar LIBOR on the prior Monday, the 13th of the month. So that 13th of the month, whatever it is, that is your original IBOR rate record day. So when you go to the Bloomberg screen to determine what your fallback rate is, you look at the screen at the end of your period, but when you are looking at the screen, you are looking for the fallback rate that is tagged to or labeled in the column for your original IBOR rate record day. So if that is, for example, 3 month and it's the 13th of January in my example, you would be, whenever your payment date is in April, you would go to the Bloomberg screen and look for the fallback rate for an original IBOR rate record day of the 13th of January. And the contractual terms tell you to go to Bloomberg screen 2 local business days prior to your payment date. And that is to ensure that you have the information about the rate at least 2 local business days prior to your payment date. Now, of course, for US dollar LIBOR, you have those rates at the beginning of the period, but because the fallbacks are based on SOFR compounded in arrears, you do have to observe them at the end of the period. But the mechanism that we have built in to look at that rate 2 days prior, which, as Jonathan mentioned, is consistent with the way Bloomberg publishes the rate with the 2-day lag to ensure that in most cases, the fallback rate for your original IBOR rate record day will be available 2 local business days prior to your payment date. However, as Jonathan alluded to, sometimes it's not available by that date. So, John, do you want to go into what happens if you go to the screen on that day and the fallback for your original IBOR rate record day is not available?
Sure, yeah.
You have a nonlinear product.
Yeah, as explained, like sometimes, the way that the Bloomberg calculates the rate, by compounding over an offset accrual period, sometimes that accrual end date won't be until after the fallback observation date, which is 2 business days prior to your payment date. And so what do you do then? Well, if it's not published by that day, you don't go into a different fallback or anything. This is a screen. The fallback is a screen-based rate, not a calculation agent calculated rate. So you just observe the fallback rate that has been published by Bloomberg for the most recent IBOR, for the most recent rate record date corresponding to your IBOR and your tenor. So, for example, if you were looking for a 3-month a fallback rate for 3-month LIBOR, and on your fallback observation date, you look at the Bloomberg page, and the rate for that rate record date hasn't been published. You look to see if a rate for the next previous rate record date has been published. If that has been published, then you use that as your fallback rate. If the next and so on, you see, basically you just keep going back until you find a fallback that has been published by Bloomberg for that particular IBOR and for that particular tenor that has been published for a particular IBOR rate record date, and you use that as your fallback. Now, this basically has the same effect as dynamically shifting the accrual period that Bloomberg calculate the fallback over. So obviously, as Jonathan explained, there is an offset lag of 2 business days. That was implemented, as Jonathan explained, to ensure that for the majority of cases, the fallback rate will be able to be published by Bloomberg 2 business days prior to your payment date, but not all the time. For example, if there is a bank holiday around about the accrual end date, then that won't be possible. So by this cutoff date, basically has the same effect of dynamically increasing that offset lag by a number of days, basically to ensure that you always have a rate available on your fallback observation date. So that's basically how it works. So, but what about for sort of non-standard swaps? What about if you have a swap with a non-standard period? Say you have an initial period where you have you've applied a 3-month LIBOR to a stub period of, say, where the calculation period is, say, between 2 and 3 months. If you've used the 3-month LIBOR, you've applied 3 months LIBOR to that stub, then you do exactly the same thing. 2 days prior to your payment date, you look at if the fallback rate has been published by Bloomberg for the 3-month for 3 months LIBOR for your original rate record date. That will be unlikely because your calculation period is shorter than the IBOR period, so it's 2.5 months versus 3 months. But there will still be a rate that you can use there because you will just use the most recently published fallback rate. So you will basically use dynamically shift the observation period that Bloomberg uses by half a month, and you will just use the most recently published fallback rate for the 3 months LIBOR on that 2 business days prior to the payment date. So the most important thing to remember is that the fallback rate, as per the ISDA definitions, is a screen-based rate. So you don't really need to know how Bloomberg calculate the underlying fallback rate, just as you didn't really need to know how IBA publish and calculate the LIBOR rate. All you need to know is that on your fallback observation date, you look to see if a rate has been published for your particular rate record date, for the particular LIBOR and the particular tenor. If that hasn't been published, you go back to the next previous record date and see if one has been published, and you keep going back until you find one that eventually has. So you don't need to do any calculation. The only time when you do need to do a calculation is when linear interpolation applies in your confirmation. So say, for example, in that example I've given, you have an initial stub of, say, 75 days, and you've stated in your confirmation that linear interpolation applies between 1 and 3 months. So in this case, the calculation agent does have to actually perform a calculation. And what the calculation agent would do, it would basically, if this is a US dollar trade, it would compound SOFR over the calculation period that is backward shifted by 2 days, just as you would do for a standard OAS transaction. And you would calculate that compounded SOFR over that period, and then you would add a spread to that, and the spread that you would add would be the spread that is interpolated between the next shortest spread and the next longest spread that has been published by Bloomberg. So that would be the spread for 1 month and the spread for 3 months. You would interpolate that spread and then add that to your calculation of the SOFR accrued over your irregular calculation period. And note that if linear interpolation applies, you don't interpolate between, say, the 1 month fallback rate and the 3 month fallback rate. And at the time of devising these, it was decided that would be way overly complicated. And actually, it would be economically really nonsensical, because if you think about it, because of the application of the cutoff, you would not, the 3 month rate would actually be backward shifted by, approximately, 30 days. So you would be interpolating between 2 sort of non-economically aligned rates there. So the most economically aligned thing to do was to actually accrue the SOFR over that irregular period and then add the interpolated spread. So that's the only time where the calculation agent would need to actually make a calculation instead of just observing what the actual rate is on the Bloomberg screen on the fallback observation date. Thanks.
Thanks, John. I think we're going to go to the next slide, which is some helpful notes and observations about the Bloomberg fallbacks. I think these will be made available to listeners and published, but in the interest of time, let's go ahead to the next slide and turn it over to Dave from CME to go through the very eminent conversion process for their exchange traded products.
Hi, everyone. As Ann mentioned, I'm Dave Arif. I'm on the interest rate team at CME Group for the listed Eurodollar futures and options. As mentioned, this is very timely. Our fallbacks, which have been very much client feedback driven, economically accurate, operationally simple, which you'll see very shortly. And also, most importantly, is they're aligned with the economics of the ISDA fallback methodology for the OTC swaps. Namely, very important to us as we make use of the 26.161 fallback spread. Now, why this is timely is this transition is going to take place tomorrow afternoon at the close of business, so on April 14th. So you're hitting us in the 11th hour for this. Now, some key principles to keep in mind for the Eurodollar futures and options fallbacks is that all of our eligible open positions at the time of the conversion are going to be terminated, all the Eurodollar futures and options, and replaced by an equal number of the corresponding SOFR contracts, both in the futures and the options. Now, the futures, we'll go into a little bit more detail in another slide, but it's very simple, where we're just going to take the ISDA fallback spread of the 26.161 and add that to the final Eurodollar future settlement price. This will create the onset price for the new positions in the 3-month SOFR futures contracts. And the Eurodollar positions will simply be closed out at that daily settlement price. Now, the options are a little bit more complicated, and we won't go into a lot of detail on it, but it's really a 2-step simultaneous process where the SOFR strikes are mapped to non-standard strikes. As you know, we do list standard strikes in our futures and options products, or in the options products. However, these will be mapped temporarily to a non-standard Eurodollar strike, which is the exact spread of that 26.161 basis points. These strikes are then going to be compared to the nearest standard Eurodollar option strike, which is in all cases 1.161 basis points away. And we're going to calculate the correct premium adjustment for the replacement SOFR options. But a real simple, easy thing to remember is that in all cases, the Eurodollar strikes will be mapped to a SOFR option strike exactly 25 basis points higher, after everything's happening in the background underneath the hood for that transition, but everything will be done at 25 basis points higher. So importantly, only positions in the futures and options with an underlying future expiring after June 30th, 2023 will be in scope for this conversion. So that's really starting with the SEP 23 contracts in both the futures and options. Said differently, the only Eurodollars that are going to be left after the conversion are the April, which actually expire this weekend as well, the May and the June Eurodollar futures and their options. And these will be listed through their typical expirations, and this will culminate with the June IMM expiration in mid-June. And then at that point, all Eurodollar futures and options will be gone. However, for the next 3 months, we will have a few Eurodollar futures and options. All right, so I won't spend a lot of time on this slide. However, we just really wanted to show that, over the last year, SOFR futures and options have become the leading liquidity pool. In fact, when you look at Q1 of 2023, our SOFR futures and options volume has surpassed the 40-year historical performance of the Eurodollar futures and options franchise, with our volumes exceeding the best years that we ever saw in Eurodollar futures and options, which is really a great testament to just really across the board how well this transition has gone, throughout both the OTC and in the listed. SOFR futures are up 33% from our best year ever in the Eurodollar futures, trading over 4 million contracts a day. And the options are up 50%, trading over 2.5 million contracts a day. Now, on the chart on the left, I won't spend a lot of time on this. However, this really demonstrates how the volumes have moved compared last quarter of last year or first quarter of last year to first quarter of this year. And really impactful if you look at something like the SOFR options open interest, which is now at over 38 million contracts. If you look exactly a year ago, that open interest was at just over, right around 1.5 million contracts. And it's really equal or surpassed both in futures and options, the historical numbers that we did see in the Eurodollars. So now on the right-hand side, just want to point out, we will be moving over 7.5 million contracts from Eurodollars open interest into the SOFR open interest. So following this conversion tomorrow, there'll still be some remaining Eurodollar options open interest of about 3 million contracts. But again, that's in the still listed April, May, and June contracts. But ultimately, and in summary, after tomorrow, 7.7 million contracts will be moved into the SOFR futures and options. So to briefly go through the fallback processes for the Eurodollar futures, again, we're going to take the Eurodollar future settle. To that, we're going to add the 26.161 ISDA spread, and that will result in the onset price of the 3-month SOFR futures. So really a quite simple process with that. One important thing to note is the final settlement price of the Eurodollars only goes out 4 decimal places. And this conforms with typical client infrastructures technology. And so the impact of the additional thousandth of a basis point, that 0.001 basis point, it will be handled with a balancing cash flow between the long and the shorts, a residual amount that will be made up, so it'll be made economically whole for both the longs and the shorts throughout the process. All right, so as mentioned, there's a lot going on with the options, and it gets pretty complicated. But in short, the options will follow a 2-step process. This will happen simultaneously and all behind the scenes. But basically, the SOFR strikes will be mapped to a temporary Eurodollar strike, which is 26.161 basis points lower than that SOFR strike. These strikes and the volatilities will then be compared to the standard Eurodollar strike, which is 1.161 basis points away, and the correct premiums will be calculated, and this will result in the adjustment to both the longs and the shorts, making up for this premium differential. But again, really the point to remember is that in all cases, the Eurodollars will be mapped to a SOFR strike 25 basis points higher. So to put it down, a Eurodollar 95 even strike will be mapped to a 95.25 SOFR option strike, even though there's a lot happening behind the scenes in our clearing processes. As this is pretty imminent, I just wanted to go through some quick operational updates on this. Again, the conversion is taking place tomorrow, April 14th at close of business. Some very important reminders is we're really encouraging clients to finish up trading today. Everything will be listed. Everything will be available for trading tomorrow, but we're asking people to either not trade these converting contracts or really to limit any type of trading. Now, to be clear, everything will be listed. Everything will be available for trading as normal throughout the day. However, there are many, we'll say, post-close clearing operations that take place. And if there's any delays on clients and FCMs in terms of processing things like transfers, give-ups, typical what we call post-clearing operations, this could result in some, I'd say, operational inefficiencies for the clients. So really, we've asked people, and we've seen this in the Eurodollar futures and options volume, that people really have stopped trading these contracts for the most part, but we're asking to limit or not to trade tomorrow, but everything will be business as usual. Fees are waived for the entire conversion. So again, everyone is economically whole and there's no fees for this conversion that's taking place. And importantly, following the conversion, the only contracts in the Eurodollar futures and options that will be left will be the April 23 contract, which actually expires this weekend. The May 23 and the June 23 contracts will remain listed with market data and trading available in those. But this is really important because if you do use Eurodollar data for things like curve construction, valuation, pricing purposes, it's imperative, and obviously this presentation from was long ago, but it's imperative that you switch to SOFR ahead of this transition tomorrow to avoid any type of disruptions, because there will not be Eurodollar futures prices being published beginning with that SEP 23 contract. Finally, we do have some resources that everyone can link to through the deck. The top link is our implementation plan, where we go into a lot more detail on how the conversion will take place, specifically with the options products and a little bit of the math behind that. The indicative cash flow report is incredibly useful as it allows you to enter in your Eurodollar futures and options positions. And you can see exactly what the transition would look like for you from a position standpoint and an economic standpoint, as if the transition were taking place on that previous night. And this is the file that really will give people an accurate portrayal of what's going to happen in clearing this coming weekend and how their positions will work. And then finally, if there's any questions, we encourage anyone to reach out to us. The email address, listed conversion inquiries at cmegroup.com, has a lot of eyes on it. So if anybody has any questions on it, please feel free to reach out to us and we can answer any questions you might have. So with that, Ann, I'll turn it back to you for our next presenter. So thank you, everyone.
Sure. Thank you very much and good luck this weekend. Now let's jump to the OTC world and start with Bill from LCH.
Excellent. Thanks, Anne. And thanks, Dave, for that review of the arrangements at CME on the listed side. As Anne said, we're now going to move to look at cleared OTC. Each CCP that's going to talk to you over the next few minutes has a slightly different approach. But I think it's fair to say that there's very much more in common to CCP conversions than there are differences. So let me go first with the conversion process at LCH SwapClear. Essentially, we are over two tranches with the dates listed as on this slide. We're going to convert outstanding dollar LIBOR contracts into what we're calling market standard SOFR OIS. Let me try and go through, I think, what are the relevant points that I want to draw out. In terms of the types of contracts and the scope of conversion, I think it's important to say that we will be converting all contracts that rely on at least one non-representative LIBOR fixing. But said the other way, we will not be converting trades that rely entirely on representative LIBOR fixing. So if I can give an example, if you have a trade cleared with LCH that matures in September 2023 and that is against 3-month LIBOR rolls, the final fixing for that trade would be in June. LIBOR, 3-month dollar LIBOR is representative in June. Therefore, there is no benefit, no need to convert that trade. So trades that are we call fully fixed will be left alone. Trades that rely on at least one non-representative LIBOR fixing, they are in the scope of the conversion. Now, in terms of the conversion itself, we are reliant on ISDA's fallback, so everything that's been set up to now in terms of the economics. But I think it's important to really emphasize the point that Anne made. We are explicitly changing the contracts so that they no longer make any reference to LIBOR in those fixings, and they exclusively refer to SOFR. The SOFR FRO that's involved is what in the market we refer to as sort of standard backward-looking realized SOFR compounding. That's the self-compounding FRO that Anne talked about. And we are respecting the accrual start and end dates of those interest periods on those contracts. And we're introducing a payment lag to deal with the issue that Jonathan raised regarding knowledge of the rate that's applicable for the period in time for the arrangements to be able to be made to make the payment. So that's what we're meaning by market standard SOFR. We're leaving non-LIBOR legs entirely untouched. Everything about a non-LIBOR leg will stay as per the contracts that you originally submitted to us. So nothing to worry about in that respect. In terms of the two tranche process that we've announced, the products involved, you can see in front of you what is involved in tranche 1, what is involved in tranche 2. One thing I want to highlight there, we have relatively recently deferred LIBOR versus Fed funds basis swaps from tranche 1. They are now part of tranche 2. Gives you a little bit of extra time to deal with those contracts, and also means that they will convert in line with the bulk of the rest of your portfolio. So really variable notionals and zero coupon swaps are the things that are getting converted. And that first conversion is less than 10 days away. It's the weekend after next. As Dave said, we've got the listed event this coming weekend. I'm afraid no pause for breath. We go straight into LCH's tranche 1 the following weekend, the weekend of the 22nd, 23rd of April. We're preserving representative LIBORs. That's being done via an overlay approach. You'll hear that other CCPs are using a slightly different way of achieving that, but for LCH, we achieve that preservation through the overlay bookings. We are compensating in cash for the difference between the fallback and, as we've loosely describing it, the sort of 2-day observation period shift that is introduced via the fallbacks relative to the non-shifted payment lagged SOFR, the standard SOFR that you would get as your conversion product output. Legally, this is being done as an amendment. Operationally, we're cancelling and rebooking all of the trades involved. Again, lots of good detail on that in other decks, but those are the principles that are involved. We've set out all the fees associated with the process in a circular that's highlighted here, which you can look up and go through and see. And the final thing I wanted to say on this slide is that the process as a whole, we're really keen that people continue to proactively transition to the best extent that they can. We've seen good evidence of that going on already, but clearly there are a few weeks left for people to perform further proactive conversions, and we're strongly encouraged that that continues. Just a few key dates here. The ones highlighted in green font are behind us. Most recently, we have the dress rehearsals. Everyone involved in those dress rehearsals, thank you very much for your engagement. They were very successful. They were quite significant in size. So we had both functional and non-functional performance testing there, which was really positive. We move through now into the production events. As I've mentioned, in the weekend after next, we have tranche 1. The weekend of the 20th, 21st of May, we have tranche 2. That's most of the products that we have cleared at LCH. And then we have a Singapore dollar and Thai baht conversion. Those rates, as many of you will know, are dependent on dollar LIBOR, so they cease also on the 30th of June this year. So we need to convert those products as well. We just wanted to finish with some information specifically relating to the period running from essentially now and when these conversions start to happen through to the 30th of June. So really just the second quarter. There are arrangements beyond the end of the second quarter, but this slide really deals with what we face over the next few weeks, April, May, June. You can see here that the eligibility for zero coupon swaps at LCH will finish as of the first tranche conversion. Everything else will remain eligible. There are slightly more convoluted booking models for some of the basis products, but you can get them into us if you need to. So that will apply up to tranche 2, and also then beyond the tranche 2 date in May, between May and up until the end of June. We have also a legacy LIBOR solution that will deal with trades that you send us beyond that point. Slightly more limited scope, slightly more limited eligibility for those products. Details of that eligibility, again, are available in other information. And broadly speaking, you get a sort of on-the-day compensated conversion using that process beyond the tranche to date. So lots to digest, I appreciate. Hopefully most of this is pretty familiar to most of you, but there is lots of information available. You are welcome to get in touch with us if you need to have any more detail on anything that I've covered. And what I'm now going to do, and I can either hand back to you or possibly hand straight across to Steve if you want to pick up how CME is handling the OTC side.
Hello, everyone. This is Steve DeYoung I'm look over OTC clearing at CME. I've worked with both Dave and Phil for a long time here. In fact, I can remember a conference, it seems like years ago, where Phil suggested the idea of a conversion. And Phil, thank you very much for that. I have a lot of gray hair now, thanks to you, and working through this. But as Phil mentioned, and Dave hit on this as well, the general idea here is to create a single pool of liquidity. And that's why we're going through the conversion event. The idea is, instead of having fallback swaps continue to reference LIBOR, we're going to update them so that they reference SOFR directly to create this single pool of liquidity. The key principles at CME very much aligned across listed and the LCH conversion proposal as well, right? So we are going to maintain all representative LIBOR fixings. We will restate non-representative LIBOR fixings by booking forward-starting SOFR OIS swaps that'll maintain the original fixed rate and add the spread adjustment that Jonathan spoke about to the floating leg of the swap. Unlike the ISDA fallbacks, we will not be recognizing a 2-day observation period shift, so that is a change. We will have a compensation amount that will account for any differences in valuation between the legacy LIBOR swaps priced using fallbacks and the replacement swaps. So people will be compensated at the time of the conversion for any P&L changes. But the general idea is, because we're using the same fixed rate and adding the fallback spread, that the changes to risk and the changes to the P&L are absolutely minimized. And then we're going to characterize, much like LCH, we're going to characterize this conversion process as an amendment and process it as a cancel and a rebook, simply from an operational standpoint. So we have had 4 large dress rehearsals at CME to prepare for these upcoming conversions. The first 3, we practiced all the major conversion events, the basis swap splitting, the primary conversion, and then the zero coupon conversion. So there's basically three events. And we did this testing our internal systems, market search synchronization, our clearing members, and the dealer community. In the 4th dress rehearsal, we invited a large subset of our clients to participate. So we feel like this has really been tested, and we are ready for a primary conversion on April 21st. You might notice we already have completed our basis swap splitting on March 24th. April 21st, so a week from Friday, will be the big date for CME. It will be followed by a secondary conversion on the first good business day following the index cessation effective date, July 3rd, where we'll handle zero coupon swaps. And this is the point that CME will start running daily conversions. Phil hinted to this as well. But if you have like a swaption expiry that is set to physically settle, CME will continue to support LIBOR trades submitted for clearings, provided that they are spot or forward starting, and that will be part of a daily conversion run that will start on July 3rd. Just want to walk through and I'm going to keep this real quick, a very simple example of a 1-year swap. Let's just say that the start date is 4/15/23. It's a 1-year swap, and both the fixed and the floating leg are 3-month payment frequency. So the way CME is going to handle this is we actually don't use a swap overlay. We book a short dated LIBOR swap to account for that last representative LIBOR fixing. So in this case, that short dated LIBOR will have a start date of 4/15. It will mature on 7/15. So it'll capture that last representative LIBOR fixing. And then any non-representative fixings will be booked as a forward starting SOFR swap. So the start date on that forward starting SOFR swap would be 7/15/23, maturity 4/15/24. Fixed rate matches the original swap, payment frequency doesn't change. Just a couple of differences here, right? So we mentioned that CME, we maintain that representative LIBOR fixing a little bit different than LCH does. We also add a 2-day offset to both the fixed and the floating leg of the swap. It's just a matter of opinion. Any differences accounted for would be captured via that cash compensation. And then one other key difference between CME and LCH is we actually process the conversion as part of the end of day process on Friday, April 21st. So our conversion date is April 21st, and that cash compensation amount that we're going to attach to the forward starting SOFR swap will settle that following Monday, 4/24. So just some small nuanced differences between CME and LCH. On the right here, I just wanted to highlight one of the exceptions to the rules that we've discussed. We talked about maintaining payment frequencies. If we had a swap, and we do have plenty of these, which has a 6-month payment frequency on the fixed leg, and the floating leg is a 3-month frequency, and one of the swap just sets up so that one of the quarterly payments is representative and the other one is non-representative, CME will actually break the payment frequency for that period on the fixed leg. And so we'll do this by booking a single term swap to capture the representative portion, and then a short stub on the swap to capture the first non-representative. After that point in time, we will revert back to the 6-month payment frequency on the fixed leg. But I just did want to highlight that one exception to the rule here. I just wanted to point out some resources to everybody. I do believe Ann said that this deck would be forwarded. So hopefully these links are live in the deck, but we have our rulebook filing, detailed conversion plan. This is about a 54-page document on our website. We have 4 conversion videos. These are very high level, 2-minute voice actors were hired just to give people a better understanding of the key parts of the conversion. And then much like the contact information that Dave provided earlier, cleared swap conversion at CME Group has a lot of eyes on it. Our big conversion is Friday, April 21st, so just around the corner. If you have any questions at all, you can reach us at that email.
We can first go over the crucial dates while addressing the approach Eurex has adopted or will be adopting for the upcoming USD LIBOR conversion. So 21st April 2023, which is Friday next week, is the last date till which trades having the underlying rate as USD LIBOR can be submitted for clearing at Eurex, after which such trades would be clearing ineligible. So besides this, starting the start of 21st April, Eurex will block, or let's say will not permit, any posted events, PTEs, to be performed on any cleared USD denominated OTC transactions. So not only USD LIBOR, but any USD denominated OTC transactions. So now following this, on Saturday, just like CME, that is on the 22nd of April, is the date of conversion of the USD LIBOR swaps. The only swaps that won't be converted and will be, let's say, retained intact are those that have a floating leg in the final period and a final LIBOR fixing before the index cessation, which is June 30th of this year. Trades would be terminated and a new replacement trades would be created on this particular day for sure. The timestamp of novation for these newly created replacement trades, however, will be of the following trading days, which would be Monday, 24th of April. On the 22nd, the new and the terminated transactions would also be synchronized with MarketWire. Here, one point to note would be that only the trades which were originally submitted for clearing via MarketWire to Eurex, and for the members, and only for the members who have enabled the synchronization, only for them the trades would be synchronized. So additionally, the replacement trades will be attached with their relevant compensation fees on this day. This is a normal practice, just like the other CCPs. The amended replacement trades, would go through the margining as well as the valuation processes at the beginning of the day on the 24th, Monday, which is also the first trading day following the conversion date after the 22nd. So the settlement date for the upfront fees, which would also include the compensation fees for the converted trades or the terminated trades, as termination fees in some cases would be settled on 25th Tuesday and not on the 24th, unlike like the other CCPs, but it would be on the Tuesday, 25th. On this day, the previously restricted ability to perform post-trade events on any OTC transactions denominated in USD will also be, enabled. So speaking now of the conversion approach, it is the same as the previous LIBOR conversions for swaps denominated in USD LIBOR. For USD forward trade agreements, since the maximum maturity was lowered to March 31st, 2023, and the clearing eligibility was restricted, we have no exposure to forward trade agreements with USD underlying. There are therefore no USD FRS to convert. The contractual reference for all outstanding USD LIBOR interest rate swaps shall be converted from LIBOR to SOFR in line with the known standard practice. Basis swap splitting will not be used, or will not be employed, and the floating legs of basis swaps with LIBOR on both legs will be shortened. That, in my opinion, is also in keeping with the ISDA's preference for this conversion by incorporating the fallback spread that will be provided by ISDA and Bloomberg. The discrepancies, in present value that emerge from the conversion from LIBOR to SOFR will be mitigated. Moreover, Eurex will not impose any additional compression fees or any other charges for this conversion. Most of the trades which will be converted in the process, coming to the gray area, the gray box at the bottom, most of the trades which will be converted in this process have all their LIBOR fixings and settlement dates known, which are prior to the index cessation date for the current floating period. So replacing such trades with pre-replacement trades will be the most common conversion approach employed. And so for OIS trade will with the exact same start and maturity dates as the original LIBOR trade that is being terminated would be the first replacement trade. For the known LIBOR fixings, the second trade would be the short LIBOR IRS trade, and the third trade would be a short OIS transaction that would be exactly the same, identical start and maturity dates as the short LIBOR IRS trade, the R2 in this particular presentation in the gray box below. And same for us. If you have any questions, please reach out to me. My contact details are on the next slide, as well as you can reach out to us via our client services.
Thank you. We do have some additional information in these slides that I can confirm will be made available to all attendees. We've received quite a few questions. I'm only going to have time to answer one, but then we're going to follow up with either a call or recording or in writing to attempt to respond to all of the questions that we've received. If you have additional questions, please also do get in touch with those, and we'll try to answer everything in the coming days. One question we received was what happens to a non-cleared derivative that has not been remediated? And I take that to mean has not been amended either via the IBOR fallbacks protocol or otherwise to include the fallback rates. One thing to keep in mind is that if that swap was entered after the 25th of January, 2021, it does not have to be remediated. because that's the date that the definition started including the fallbacks. If it is not remediated and it was entered into prior to that date, first, I would say there is still time to remediate it. You and or your counterparty can still adhere to the IBOR fallbacks protocol to include those fallbacks. If your contract is governed by US law, the LIBOR Act and the Federal Reserve's implementing regulation may apply. Everyone has to analyze their contracts, but that does explicitly apply to derivatives. And the Fed's regulation would actually apply the fallback rates published by Bloomberg. So you could very well end up in the same place. If your non-clear derivatives contract entered into prior to the 25th of January 2021 that hadn't been remediated is governed by a non-US law, the UK FCA recently announced that it expects IBA to provide synthetic US dollar LIBOR through the end of September 2024. And it's possible that that published rate would apply to your contract through that date. And synthetic US dollar LIBOR will be based on a rate we haven't covered today, which is CME term SOFR, a forward-looking rate, plus the ISDA spread. But if you have that unremediated contract, I would encourage you to attempt to remediate it or analyze whether either of the solutions I just mentioned apply to it. Thank you very much to my panelists. Good luck in the coming days, weeks, and months with all of this work. And thank you for attending. We will be in touch to follow up with more information.